In this module, we shall study about revaluation of fixed assets and income measurement. A revaluation of fixed assets is a technique that may be required to accurately describe the true value of the capital goods a business owns. This should be distinguished from planned depreciation, where the recorded decline in value of an asset is tied to its age. The purpose of a revaluation is to bring into the books the fair market value of fixed assets. This may be helpful in order to decide whether to invest in another business. If a company wants to sell one of its assets, it is revalued in preparation for sales negotiations. After starting this module, one shall be able to first define the concept of fixed assets, second understand the concept of revaluation of fixed asset, third analysis the provisions of AS 10 in relation to revaluation of fixed asset, fourth interpret accounting treatment of revaluation of fixed assets in different situations, fifth analysis difference between Indian accounting standard and Indian GAAP relating to provisions of revaluation of fixed assets, sixth understand the concept of income measurement, seventh learn the objectives of income measurement. Let us now understand the meaning of fixed asset. Fixed asset is an asset held with the intention of being used for the purpose of producing or providing goods or services and is not held for sale in the normal course of business. It is expected to be used for more than one accounting period. The cost of fixed assets includes purchase price, direct cost incurred to bring the asset to its working condition, installation cost, import duties and other non-refundable taxes, professional fees like fees of architects, general overhead of enterprise when these expenses are specifically attributable to acquisition preparation of fixed assets, any expenses before the commercial production including cost of test run and experimental production, loss on deferred payment arising out of foreign currency liability, price adjustment, changes in duties and similar factors. The cost of fixed assets is deducted with trade discounts and rebates, sale proceeds of test run production, amount of government grants, received receivable against fixed assets, gain on deferred payment arising out of foreign currency liability. We shall now discuss the revaluation of fixed assets. When the fixed assets are revalued, these assets are shown at revalued price. Revaluation of fixed assets should be restricted to the net recoverable amount of fixed asset. When a fixed asset is revalued, an entire class of assets should be revalued or selection of assets for revaluation should be made on a systematic basis. That basis must be disclosed. Provision as per AS 10. Amount substituted for historical cost. A. Sometimes financial statements that are otherwise prepared on a historical cost basis include substitution for historical cost and depreciation is calculated accordingly. Such financial statements are to be distinguished from financial statements prepared on a basis intended to reflect comprehensively the effects of changing prices. B. A commonly accepted and preferred method of restating fixed assets is by appraisal, normally undertaken by competent valuers. Other methods sometimes used are indexation and reference to current prices, which when applied are cross-checked periodically by appraisal method. C. The revalued amounts of fixed assets are presented in financial statements either by restating both the gross book value and accumulated accumulated depreciation so as to give a net book value equal to the net revalued amount, or by restating the net book value by adding therein the net increase on account of revaluation. An upward revaluation does not provide a basis for 102 AS 10 crediting to the profit and loss statement the accumulated depreciation existing at the time of revaluation. D. Different bases of valuation are sometimes used in the same financial statements to determine the book value of the separate items within each of the categories of fixed assets or for the different categories of fixed assets. In such cases, it is necessary to disclose the gross book value included on each basis. E. Selective revaluation of assets can lead to unrepresentative amounts being reported in financial statements. Accordingly, when revaluations do not cover all the assets of a given class, it is appropriate that the selection of assets to be revalued be made on a systematic basis. For example, an enterprise may revalue a whole class of assets within a unit. F. It is not appropriate for the revaluation of a class of asset to result in the net book value of that class being greater than the recoverable amount of the asset of that class. G. An increase in net book value arising on revaluation of fixed assets is normally credited directly to owner's interest under the heading of revaluation reserves and is regarded as not available for distribution. A decrease in net book value arising on revaluation of fixed assets is charged to profit and loss statement except that to the extent that such a decrease is considered to be related to a previous increase on revaluation that is included in revaluation reserve. It is sometimes charged against that earlier increase. It sometimes happens that an increase to be recorded is a reversal of a previous decrease arising on revaluation which has been charged to profit and loss statement, in which case the increase is credited to profit and loss statement to the extent that it offsets the previously recorded decrease. We shall now understand the accounting treatment of revaluation of fixed assets in different situations. When asset is revalued during its useful life period, then such revalued price should be recorded in the books of accounts. When revaluation of assets is made, it should be in systematic manner for each class of asset, and the same should be disclosed in the general purpose financial statements. Presentation of such revaluation can be done by any method according to upward and downward revaluation. It can be done by creating revaluation reserve. Following are the situations and its treatment. First, when revaluation is made upward. For the first time, revaluation of asset which results into increase in net block revaluation reserve should be credited, and the same shall be disclosed at equity and liability under the head of shareholders fund as per revised schedule 6th. Fixed assets account debit to revaluation reserve. Second, when revaluation is made downward. For the first time, revaluation of asset which results into decrease in net block, it should be charged to profit and loss account. Profit and loss account debit to fixed assets. Third, when revaluation is made upward subsequent to previous upward revaluation. If first revaluation is increase in net block and subsequent revaluation results into increase, then it shall be credited to revaluation reserve. Fixed assets account debit to revaluation reserve. Fourth, when revaluation is made downward subsequent to previous upward revaluation. If first revaluation is increase in net block and subsequent revaluation results into decrease in net block, then to the extent of earlier increase or credited revaluation reserve should be utilized and balancing amount should be debited to profit and loss account. Revaluation reserve account debit to the extent of carrying amount of revaluation reserve, profit and loss account debit, that is the balancing figure, to fixed assets. Fifth, when revaluation is made upward subsequent to previous downward revaluation. If first time revaluation is decrease in net block and subsequent revaluation results into increase in net block, then to the extent of earlier decrease, it should be credited to profit and loss account and balancing should be credited to revaluation reserve. Fixed assets account debit to profit and loss account to the extent of previous downward revaluation to revaluation reserve, the balancing figure. Sixth, when revaluation is made downward subsequent to previous downward revaluation. If first time revaluation is decrease in net block and subsequent revaluation is also results into decrease, it should be charged to profit and loss account. Profit and loss account debit to fixed assets. Seventh, accounting treatment on disposal of fixed assets. On sale of fixed assets, bank account debit, profit and loss account debit if loss, to fixed assets, to profit and loss account if profit. Eighth, on sale of fixed assets where upward revaluation has taken place. On disposal of a previously revalued item of fixed asset, the difference between net disposal proceeds and the net book value is normally charged or credited to the profit and loss account, except that to the extent such a loss is related to an increase which was previously recorded as a credit to revaluation reserve and which has not been subsequently reversed or utilized. It is charged directly to that account. The amount standing in revaluation reserve following the retirement or disposal of an asset which relates to that asset may be transferred to general reserve. If loss, bank account debit, revaluation reserve account debit, profit and loss account debit to fixed assets account. Next entry, revaluation reserve account debit to general reserve. If profit, bank account debit to profit and loss account to fixed assets account. Next entry, revaluation reserve account debit to general reserve. Let us discuss the difference between Indian accounting standard and Indian GAAP. First basis, revaluation model for subsequent measurement. Indian accounting standard permits. On the other hand, Indian GAAP also permits. Next basis, if an asset is revalued, revaluation to be done for the entire class of property to which that asset belongs. Indian Accounting Standard 16 mandates requires revaluation to be updated periodically. On the other hand, it is not required for all the assets of the given class according to Indian GAAP. Next basis, need to update revaluation periodically. According to Indian Accounting Standard, yes. On the other hand, according to Indian GAAP, no. Moving on to the income measurement. Income may be defined in many different ways. The two dominant income views is that of the accountant and the economist. From an accountant's perspective, income is defined as the residual portion of revenue which is the result of subtracting total revenues generated from the total expenses incurred by a company during the revenue earning phase. An economist defines income in terms of residual expected cash flows available from consumption after dividends and equity application has been taken into account. Although the accountants and economists' view of the income concept differ, as one deals with historical values and the other in future expected cash flow, its importance is of vital use. Let us understand the objectives of income measurement. Income as a measure of efficiency. Income provides a basic standard by which success is measured. Shareholders assess the soundness of their investments through reported income. Income as a guide to future investment. Current income acts to influence expectations about the future. This is particularly so as regards investors who have to rely on financial reports and whose willingness to hold and to subscribe for further shares will be affected by reported income. Income as an indicator of managerial effectiveness. Managerial effectiveness as a decision maker and as a steward of resources is adjudged by reported income. Income as a tax base. The tendency of most governments to require a substantial share of corporate income in the form of taxation means that the manner in which corporate tax is assessed is critically important to shareholders and management. Although taxation legislation does not define income, it does specify what is taxable and what is deductible in arriving at a measure of taxable income. Much litigation in this area has revolved around the meaning of words, but the taxation authorities accept accounting income as the base from which to work out taxable income. Next, income as a guide to credit worthiness. A firm's ability to obtain credit finance depends on its financial status and its current and future income prospects. For this reason, credit institutions and banks rely upon firms' abilities to repay loans out of future income and look upon current income levels as a guide in this respect. Income as a guide to socio-economic decisions. A wide range of decisions take into account the levels of corporate income. Thus, price increases tend increasingly to be justified in terms of income levels, and wage bargaining procedures usually involve appeals by both sides to their effects on corporate income. Government economic policies are guided by levels of corporate income as one of the key social indicators. Income as a guide to dividend policy. How much to be distributed among shareholders as dividend depends upon income. Let us now recapitulate what we have learned so far. Revaluation of fixed assets is the process of increasing or decreasing their carrying value in case of major changes in fair market value of the fixed asset. The revalued amounts of fixed assets are presented in financial statements either by restating both the gross book value and accumulated depreciation so as to give a net book value equal to the net revalued amount, or by restating the net book value by adding therein the net increase on account of revaluation. An upward revaluation does not provide a basis for crediting to the profit and loss statement the accumulated depreciation existing at the time of revaluation. Also, selective revaluation of assets can lead to unrepresentative amounts being reported in financial statements. Accordingly, when revaluations do not cover all the assets of a given class, it is appropriate that the selection of assets to be revalued be made on a systematic basis. For example, an enterprise may revalue a whole class of assets within a unit. An increase in net book value arising on revaluation of fixed assets is normally credited directly to owner's interest under the heading of revaluation reserves and is regarded as not available for distribution. A decrease in net book value arising on revaluation of fixed assets is charged to profit and loss statement except that To the extent that such a decrease is considered to be related to a previous increase on revaluation that is included in revaluation reserve, it is sometimes charged against that earlier increase. Thank you.